VTI and FZROX are two popular funds offering broad exposure to the U.S. stock market, but they have key differences that might make one more suitable than the other depending on your investment goals. VTI, or Vanguard Total Stock Market ETF, tracks the CRSP U.S. Total Market Index, representing a broad spectrum of U.S. companies, including large, mid, small, and microcap stocks. As an ETF, VTI trades like a stock throughout the day on an exchange, giving you flexibility in when you buy and sell. This makes VTI a great option for investors who want full U.S. market exposure and the ability to trade throughout the day. On the other hand, FZROX, or Fidelity Zero Total Market Index Fund, is a mutual fund that tracks the Fidelity U.S. Total Investable Market Index. Like VTI, FZROX covers a wide range of U.S. stocks, but has a key difference. It charges no expense ratio. This makes FZROX a highly cost-effective choice for investors looking to keep their fees low. However, since it is a mutual fund, FZROX can only be traded at the end of the day, unlike VTI, which is more flexible with real-time trading. One of the main advantages of FZROX is its zero expense ratio, meaning you won't pay any fees annually, which can make a big difference in long-term returns. VTI, on the other hand, charges a small expense ratio, but it's still relatively low compared to many other funds. The fee for VTI might eat into your returns slightly over time, but its established fund structure and higher flexibility might be worth the cost for some investors. Another key difference is in the type of investment. VTI is an exchange-traded fund, ETF, which can be bought and sold throughout the trading day, giving you real-time control over your trades. FZROX is a mutual fund, and its transactions are executed at the end of the trading day at the net asset value, NAV, so you don't get real-time pricing like with ETFs. When it comes to performance, both VTI and FZROX have provided similar returns in the past, as they track similar U.S. stock market indexes. However, VTI may have a slight edge in performance due to its ETF structure, which can allow for tax advantages and more efficient trading. FZROX's lack of an expense ratio can help it keep costs low, making it an attractive option for long-term investors looking to avoid fees. In terms of accessibility, FZROX has a very low minimum investment, typically just $1, which is great for beginners or anyone looking to invest small amounts. VTI, as an ETF, can be bought in increments of a single share, which can also be affordable depending on the price of the ETF at the time. Tax efficiency is another important factor. Due to the way ETFs work, VTI may be slightly more tax efficient than FZROX because of its structure that minimizes capital gains distributions. FZROX, as a mutual fund, might distribute capital gains, but it's still considered tax efficient. In conclusion, both VTI and FZROX offer great exposure to the U.S. stock market, with VTI being a better choice for those who want flexibility in trading and slightly better tax efficiency. FZROX, with its zero expense ratio, is a fantastic option for long-term investors looking for low-cost exposure to the market without worrying about annual fees.